Yo, what's up traders? Welcome to a new video. In this video, I'm going to show you a great swing trading, price action trading strategy. And this method is all about raw price movements in the market and eventually helping you make decision based solely on what you see and not what you think. Right? So let's break down how you can use price action to enhance your swing trading approach. So first let's understand what price action is. Price action is trading. Price action trading means analyzing the basic movement of the prices to make trading decisions without using indicators. So now I'm looking at trading view. Over here we have a bunch of indicators that we can use, but we take the trades without using any indicator. And first of all, in order to become a good price action trader, we need to understand market structure. That's really important. So let me see if I have the tool that I can show you. I believe it's this one. Was it? No, it wasn't this one. Over here. So first you need to understand the the market structure before you take a single trade. So over here we have a uptrend, right? And why is it the uptrend? Because let me see over here, because the price makes a higher high and a lower high, a higher low. So and then we see a higher high and we see a higher low. So that means that we're only looking for buy trades. And over here we see that this high matches with this low. So we can also use a Fibonacci tool if you want, and then you can identify where you enter your trades. Most of the time for a nice trade we see that the market corrects to the 50 level and the 0.38 level. We call this the golden the golden space, whatever you want to call it. But from this, if price retraces to this area, then you see a bullish candle, for example, and engulfing, and then you can take the trade. So this is really handy to know before you take any trades. You need to understand the market structure. Okay, so let me see. We continue. So again, price action is about simplifying, simplicity and efficiency in trading by focusing on just the price, and we don't use any indicators. So I already mentioned it. What was really important is that you need to have an understanding of support and resistance. So over here we see that price went to the upside. We don't see that it continues. It goes to the downside, and then over here we see that price again reaches a certain level here, and we see that this is the resistance now, right? The new resistance, and then it breaks the resistance, and over here we see that it becomes a support, and then you can take a small buy. But we see that it doesn't hold again the resistance and the new support, goes to the downside until it reaches this level, which so this is the new support. If we look left, we see that this used to be the resistance level, right? Because over here, I like to work with boxes because it's better than just lines. But there was a resistance, then this was kind of a resistance, but it didn't respect it, went to the upside. But then we see price goes down, and we see that over here it reaches the support level, which is then our new support. So it used to be resistance, but now it's a support level. And support and resistance are the foundation. These levels act as a barrier where price may halt or reverse. That's exactly what we see. And the swing highs and lows help us identify these levels and understand the momentum in the market. For price action, it's also really interesting to know the market phases. So we have the trending, where the market moves in a clear direction, and we have the consolidation, where the market is range bound, and breakout, where the market makes a decisive move out of consolidation. So this is a nice trending move. You see that it keeps going, then it goes to the downside, and we see, as I mentioned, this is our new resistance, and then it goes to the upside, and this is a breakout. So it breaks out this level, and then overall we see that it starts ranging, right? So over here we have a period that it doesn't go really aggressively to the upside and also not really aggressively to the downside. So this is our ranging market phase, and then we see an aggressive buy to the upside, and then we start trending again. So this is a breakout trade. If you take a buy order, and then over here this looks like a trending market, really aggressive to the upside. All right, so recognizing price patterns is crucial. It's important in swing trading, and I will show you some common patterns. So we have the flag. Let me show you over here. This is a flag pattern. Here, so this is a flag pattern. So we see price ranges inside the flag, and then we see a bullish breakout, goes to the downside. It respects again this line, this level. It goes to the downside, takes out all of the liquidity, and then from that moment you see that price reacts and goes to the upside. So if you took a buy order here, it was a win. Again, we see the resistance, right? This level, really interesting to see, but it couldn't break out, so it goes to the downside, and then we see that it goes down, back to the support again, and from that we see it goes to the upside. Another interesting pattern, let me delete this over here. All right, let me see if I can show it. Yeah, it's quite hard. Yeah, well, over here we have a head and shoulder pattern. So over here, this is the shoulder, this is the head, and then we have another shoulder. So let me show it with some boxes. We have a shoulder, we have the head, and here we have the shoulder. So it goes to the upside. We see over here it ranges, a breakout trade, and it creates the head. This is the highest point. Goes down, drops, and again range a little bit. It goes a little bit to the upside, so it makes another shoulder. But we also see that it simply can't cross this the head, right? So there's not enough bullish traders, so it goes to the downside. Then we see this is called the neckline. Let me show you, because every shoulder and a head, shoulder, head, shoulder, then we also have a neckline, and it doesn't respect the support level, goes to the downside. But then we see over here we see a pullback to the support level, and then we see a big a bearish candle, making sure that the price goes to the downside, and if you took a sell, it was a nice trade. So this is a head and shoulder pattern, and you also have the reversed head and shoulder pattern, which is really nice, visible over here. This is the shoulder, and here we have the head, and here we have another shoulder. Then we have the neckline, and again this is also interesting. Shoulder, head, shoulder, neckline. But what do we see over here? We see that it crosses the neckline, we see a small pullback, so not a big one, but a bearish candle to the support level, right? Because it's a breakout, back to the support, pullback, and then we see a big candle to the upside. So this is a nice reversed head and shoulder pattern. Let me see a double top. Yeah, over here, this is a nice double top. So this is a top, and this is also a top, and price goes to the upside, creates a high, goes to the lows, goes down, drops again, reverses, creates another a top, couldn't go higher, and then we see that price goes to the downside. So this is a double top, and perhaps I can it's really hard because it's a trending market. Over here we have a double bottom as well. So this is one bottom, and this is another bottom. So we have two bottoms. The double bottom, again, it couldn't get lower than this. It couldn't get lower than this. So it respects this, and we see that price goes to the upside. So this is a double bottom. And so those are basically the main price action patterns. So this is really interesting to see. I would say just play around with it and see if you can identify many more. But managing your trades properly is as important as finding the right trade entries. And effective trade management that involves appropriate position trading, position sizing, and using trailing stops to protect profits. And it's also important to understand how and when to scale in and to scale out of positions. So what do I mean with this? So let's say that over here you took a buy. This is possible, but let's say that you took a buy trade. I have to reverse it. This is the buy. Yeah. So so this could be right. Over here you put your stop loss below the latest low, which is here. Then over here for a 1-to-1 risk reward ratio trade, which is good. But if you take a buy much higher, then your stop loss would be immense, would be huge. And this is not something that you really want, and that's why many people also wait for the pullback, and then from that moment you can place it here, but some people also place it down below here if they want to have a bigger lot size and a smaller stop loss. But that's something you have to identify if you're a breakout trader or a pullback trader. But you have to make sure that if you take the trade that you really watch your position sizing, that you don't take big huge lot sizes and really small stop losses, but that you give it more room, and that that you don't use too high stop losses, because in the end you will lose some trades and then you will blow your account. And another trading strategy, as mentioned, trading stop losses. What you do is that let's say, for example, you took the trade over here, the price goes to the upside, and you just trail your stop loss. So every low that it creates, you just move your stop loss to a little bit a few pips below the latest low, and then every time you just move it, price goes to the upside, price goes here, and then eventually we see that price stops you out, but your entry was here, right? So this was all your profit. This was all your profit. So that is also a nice strategy, a nice technique that you can use to just trail your stop loss. And if you see that, all right, so over here I see perhaps that the trend isn't bullish anymore. In this case, you see that it goes to the downside. So it was nice that you went out over here. Then you can use the trailing stop loss so that you always protect your profits. Let me see. So let me show you a candlestick, which is really important. And if I recall correctly, then if I remember correctly, then I heard that the bullish engulfing candle or the bearish engulfing candle is the most popular candlestick that traders use, and also the most profitable. What do I mean? What do I mean with bullish and bearish candlestick? So over here we see a huge candle with that closes above the previous one, right? So this is the last one, the previous candle. It's over here, and we see a big candle with small wicks, and this is called an engulfing bullish candle, and it means that many market participants bought at this place. On 10 o'clock, many forex traders bought gold at the moment. So not forex traders, but commodity traders. Whatever, people bought over here, and we see over here again big candles. And a bullish candle is basically a candle that closes above the latest, a bullish engulfing, but also takes out the liquidity of the previous candle. This one isn't hard; it's hard to see, but that's really the definition of a engulfing candle. Let me show you a good example, which is a 101 bearish engulfing candle or a bullish engulfing candle. This could be let me see if I see one. Nah, if I see one, then I will definitely. I don't see it. It's just an original bullish or a bearish candle, engulfing candle. I don't see it at the moment, but okay. That's the engulfing candle. We also have the pin bar, and I saw the pin bar candle over here. This is a nice hammer, we call this. We over here see that it takes out all the liquidity on the downside, and then it closes bullish, and we see that from that moment price goes to the upside. So that's a nice pin bar. It's also a really popular press action candle, and the same applies to the doji. Over here, this is a nice example of a doji trade. I mean, a doji candlestick. We have a long wick over here, and many sellers and buyers are just fighting for what price will do, and there's a lot of indecision. And because we see price goes to the downside, from that moment here we see many buyers stepping in, and sellers also want to drop the price, but there are too many buyers, and then eventually we don't know what will happen. So there's a lot of indecision. But then we see that eventually the buyers get the overhand, and we see price goes to the upside. So this is called a doji candle. Those three are basically the most important candlesticks. And so it's just maybe what I can do, I can just use an indicator which is called the engulfing candle indicator. All right, so now we see a bearish engulfing candle. So it takes out the high of the previous one, and it also closes below. There's a bearish engulfing candle, and this is a classic one. But many people also identify this as a bullish engulfing candle because it's a big candle and it closes above the previous candle, a low. I mean a bearish candle. So over here we also see a classic one. So let me see. The wick is below the previous one. We see a lot of volume, a big candle, and it closes above the high of the previous candle. So this is also a classic bullish engulfing candle. All right, so let me show you a few strategies. I mean, it's a swing trading strategy, but let me show you a few examples that you can use. So we see over here it's a breakout. We're in a trending market, and this used to be resistance, right? So price goes to the upside, we see resistance, it doesn't break over here, it goes down, but then we see that it breaks. So this was a resistance, it breaks the resistance, it goes down, and now the resistance is a support level, and we see that it respects the support level, and we see a engulfing bullish candle over here. So what do? We take a buy trade, put our stop loss below the latest low, which is here, and we can target a 1 to 2 risk reward ratio trade, but even a 1 to 3 was also good, right? So then we target the latest high over here. So this was a perfect trade, one-on-one trade. This is really nice to see that it does work, and this was just a random trade that I took. But you see, it's really important to identify, are we in a trending market, are we in a ranging market? Because over here we see, let me put the boxes, we see a double top. This is a top and this is a top, and then we see price goes to the downside. So if you would like to place a sell reversing trade, reversal trade over here, let me see, it would be a one-on-one trade. If you targeted the support level over here, then it wouldn't be enough. But if you trailed your stop loss, for example, then over here you would, then you would trail your stop loss over here, for example, and then here it would take you out with profits, right? So we see a double top, which is also a price action pattern, and I already showed you the doji, right? Price goes down, we see a doji indecision, and it goes up. Let me see another thing. Over here we see it's not really a head and shoulder, it's kind of a strange head and shoulder, because this seems like a head shoulder, so it's not a perfect head and shoulder, but of course, if this was a little bit lower and it was higher, then it would be a amazing head and shoulder pattern. And then you see also price goes to the downside, and this time we don't see a pullback, because normally this was the resistance, right? Goes to the upside. This was now support, goes to the upside, goes down to the support level again, then it breaks the support level, and now this is our resistance. We see that there are too many buyers over here, so it doesn't come back to the support level. But what do we see over here? This also was a support level, right? And we do see that it respects again the support level once, twice, 3 times. So that is interesting to see. So once the price goes to the downside and you recognize it, and you identify this as a bearish market, you can take a sell trade. Over here we also see a engulfing candle, we see even 2. Boom, we take the sell. Again, this is a huge bearish candle, a little bit pullback, and then goes to the downside again. Over here it comes back to the same level, we take a sell trade. So this is price action 101. And now I'm looking at the 4-hour time frame, which is used for swing trading. And so yeah, you don't have to trade every single day. You can just trade once a week, twice a week. It's really important to wait for the right time. And as I showed you, if there are opportunities, for example, again here, this used to be resistance, now it becomes support. We are in an uptrend, right? And as soon as it goes to the support level, we can take a buy, right? This is a nice bullish candle. Over here we see a nice bullish engulfing candle. It's a nice buy trade. So and this appears every 4 hours. So this was on a Tuesday. So let's say that you didn't get this one, there's always another opportunity about 12 hours later, right? So then you can also enter at that time and still make money. So price action is a really interesting trading technique. We don't use any indicators. We only look at the price and market structure and phases. There are many forex traders that use this technique. And I would say just go to TradingView, just pick a random chart, make sure to look at the 4-hour or the daily time frame, because those candlesticks and those patterns, they are more respected on the higher time frame. So I would say just go to the 4-hour, the daily, and just see if you can recognize these patterns and these candlesticks, and just use a demo account, play around with it, and if you like it, then just use this trading strategy. If you like this video, by the way, give it a thumbs up, subscribe, and I see you in the next video.